Central banks are doubling down on their inflation targets, just as an AI investment boom is reshaping earnings and valuations, and that clash is setting the tone for equities right now. Welcome to vTalkInsight, Equity Pulse Daily for July 2nd, 2026. Equities are coming off the strongest quarter for the S&P 500 since 2020, but the next leg now hinges on central bank messaging. All eyes are on the Sintra meetings, where speeches from the Federal Reserve, the European Central Bank, and the Bank of England could reinforce a more hawkish tone. Market pricing already implies around an 80% chance of another Federal Reserve rate hike by September, and there is a clear effort from Fed leadership to underline independence and a hard commitment to the existing 2% inflation target. The policy challenge is that the inflation picture is mixed rather than cleanly benign. Core measures such as consumer prices, producer prices, and super-core personal consumption expenditures remain well above target, and analysts highlight that AI-driven demand for energy, chips, and computing capacity is adding short-term inflation pressure. That is pushing estimates of fair value interest rates higher and keeps the door open to further hikes in major economies. At the same time, Euro area inflation has begun to ease and lower oil prices are feeding into softer headline numbers, which is why some expect the European Central Bank to deliver perhaps one more move, reach a neutral setting, and then pause. On growth, recent labor data still lean toward a soft landing rather than an imminent recession. Non-farm payrolls have been strong, unemployment steady, and the ratio of job openings to unemployed workers is back near the highs of early last year, all of which point to a resilient economy. Yet wage growth is cooling and private payrolls, as captured in the latest ADP report, came in well below expectations, hinting at slower momentum beneath the surface. Consensus looks for upcoming payrolls in the 120 to 125,000 range, with unemployment around 4.3% and wage growth near 3.5%. A combination that would support the soft landing story and potentially limit how far the Fed needs to go. Complicating things further, the Fed is deliberately backing away from explicit forward guidance, keeping July and September decisions genuinely data-dependent. That flexibility improves policy options, but also injects more uncertainty into rate expectations and is expected to keep market volatility higher through 2026 and 2027. Meanwhile, oil has just posted its weakest quarter since 2020, with Brent crude trading in the low 70s and banks like Goldman Sachs and Morgan Stanley flagging the risk of an oversupplied market next year. Yet negotiations with Iran and threats over access to the Strait of Hormuz mean the geopolitical tail risks for energy prices and European growth have not gone away, which is why the European Central Bank is still warning about stagflation-style pressures. Against that backdrop, the volatility index has slipped back into the mid-teens, and volatility risk premia have compressed, signaling a degree of complacency in broad index hedging. The key tension for equities is that discount rates may need to stay higher for longer, even as growth data remain decent, so equity risk premia have to absorb both the policy uncertainty and any future inflation surprises. Payrolls, the Sintra speeches, and incoming inflation prints will be the next catalysts for repricing that macro backdrop. Running alongside the central bank story is a powerful capital spending supercycle in AI, infrastructure, climate, and defense that is now the dominant driver of the equity narrative. Forecasts suggest hyperscaler capital expenditure alone could reach around $5.5 trillion by 2030, reflecting the sheer scale of data center and AI infrastructure build-out. This is part of a broader, multi-year increase in public and private investment as governments borrow to upgrade energy systems, onshore supply chains, and bolster defense, and corporates pivot from financial engineering toward real Capex. That spending is already feeding through into earnings expectations. S&P 500 forward earnings estimates are up nearly 20% year-to-date, and consensus growth forecasts for this year have been revised from the mid-teens to above 24%. Importantly, these upgrades are not coming off a deep earnings recession. They're being driven by robust nominal growth and strong Capex, especially in AI and infrastructure. Analysts expect earnings, rather than multiple expansion, to be the main driver of equity returns in the second half, even if the pace of gains moderates from the first half surge. Credit markets are central to funding this cycle. Investment-grade issuance in the United States set a new monthly record in June, above $75 billion, helped by large deals from names such as Nvidia and SpaceX. Private placement bond issuance has also surged to the highest levels in at least a decade, with many billion-dollar transactions tied to AI data centers and related infrastructure. Issuers are increasingly tapping multiple currencies and markets to optimize structures, and investor appetite for AI-related debt is strong, but with more selective underwriting focused on contracted revenues and sponsor quality. Strategists such as Morgan Stanley expect AI-related productivity gains to support medium and long-term growth, which is constructive for equities as an asset class. However, they also argue that in the near term this wave is inflationary because it lifts demand for energy, chips, and specialized equipment, and that the ultimate effect may be to raise, not lower, the equilibrium level of interest rates. That view aligns with asset allocation stances that remain overweight equities and commodities and structurally underweight long-duration bonds, given ongoing fiscal expansion and heavy Capex needs across the G10. There are, however, growing checks on the AI story. The United States government has just lifted export restrictions on Anthropic's latest models after the company agreed to stricter protocols, and regulators are moving from voluntary guidelines toward a more compulsory regime for frontier systems. More than 400 AI-related bills have been introduced in Congress, but progress is fragmented, leaving companies to navigate an uncertain rulebook, while the cyber capabilities of models like Anthropic's Mythos highlight real systemic risk for sectors such as banking. At the corporate level, many enterprises report frustration with token-based pricing, limited realized profit and loss impact, and concerns over data control, which is pushing value toward providers that either own differentiated data and distribution, like Microsoft, or offer profitable application layers, as is the case with Palantir. The most acute expression of AI exuberance has been in semiconductors, and that is now where the bubble debate is most intense. Semiconductor indices have delivered their largest quarterly gain on record, with price-to-sales ratios in parts of the complex exceeding 16 and the main benchmark trading at its widest stretch above the 200-day moving average since the dot-com era. In recent sessions, that momentum has snapped, with the Philadelphia Semiconductor Index down more than 6%, only a small fraction of industry names holding above short-term highs, and individual stocks such as Micron falling around 10% after reports that Apple is exploring Chinese memory suppliers. One concern is that passive indices have become heavily concentrated in this theme. Semi-related names now represent an unusually large share of broad equity benchmarks, which means that any sustained underperformance or derating in the group could translate quickly into index-level volatility. With market momentum and beta already unwinding, some allocators expect a period of consolidation over the next month or so, particularly in the most crowded areas of tech. At the same time, the structural demand story for chips remains intact. Data center spending accelerated in the first half of the year, and demand for advanced processors and memory remains robust as hyperscalers roll out new AI models. The risk flag now is that capacity constraints and supply bottlenecks limit further upward earnings revisions from here, even if absolute profits remain strong, which changes the risk-reward for a sector that has already re-rated dramatically. Beyond semis, Big Tech is actively reshaping itself around AI, with mixed equity market reactions. Microsoft is planning thousands of job cuts across sales, consulting, and its gaming division, signaling a reallocation of resources toward AI investments and tighter cost discipline after its weakest stock performance month since 2000. Meta Platforms, by contrast, has seen its shares surge nearly 9% after unveiling plans to commercialize its AI infrastructure and enter the cloud compute market, positioning itself as a direct competitor to Amazon Web Services, Microsoft Azure, and Google Cloud. That move is viewed as a potential new revenue stream for Meta, but has weighed on smaller neocloud players such as CoreWeave and Nebius, whose shares have fallen on fears of intensified competition. While tech and semis still dominate headlines, market leadership has been quietly broadening in ways that matter for portfolio construction. Small-cap equities delivered a huge rally in the second quarter, with the Russell 2000 up more than 20% and the S&P 600 small caps nearly 19%, helped by a recovery in United States manufacturing and the end of an earnings recession in smaller companies. Financials have also staged a strong comeback, with small and mid-cap banks and brokers rising around 14% in the quarter, supported by a healthier initial public offering pipeline and stronger fundamentals. Healthcare is another notable pivot point. The sector, particularly pharmaceuticals and biotech, logged almost 7% gains in June, its best month since late 2025, after a long period of underperformance. Despite that bounce, healthcare remains one of the cheaper and more unloved areas of the market, and select companies with diversified exposure and essential drug delivery products are drawing renewed interest as defensive ballast amid rising volatility in growth sectors. Strategists increasingly favor mid-caps over the smallest names for the next phase of the cycle, arguing that mid-cap companies can still outgrow large-cap profits, but carry less refinancing and leverage risk if the Fed tightens further. More broadly, valuation gaps between United States and non-United States equities are expected to narrow as earnings growth converges, creating a stronger case for exposure to emerging markets and developed ex-United States markets, especially if the dollar weakens. Japan is one example, where business sentiment is notably strong and equity fundamentals are improving even as the yen trades at undervalued levels, though currency policy remains a wild card. Recent price action underlines how difficult simple factor trades have become. Communication services, financials, and consumer discretionary stocks have shown relative strength even on days when the broad market is weak, while information technology, utilities, and industrials have lagged. This high dispersion and rapid sector rotation mean traditional momentum strategies are struggling, and the environment is less forgiving for purely passive exposure tied to last year's winners. Underneath these rotations, there is a growing discussion about financial stability as both debt and equity supply ramp up. United States initial public offerings and follow-on share sales have already exceeded $250 billion this year, reversing several years of declining net equity supply and increasing competition for capital. Regulators are also monitoring the rapid growth of hedge fund activity in sovereign debt markets, often financed with short-term leverage, which could amplify any sudden shocks in repo haircuts or funding costs. The IMF has highlighted specific risks around AI-related project finance, where the useful life of physical assets may not match the duration of the associated debt. Company-level moves are providing a more granular read on the cycle. Nike has warned about persistent consumer anxiety and weakness in Greater China, with sales there down 17% and intense competition from local brands, helping drive a roughly 36% year-to-date share price decline and spilling over into European peers such as Adidas and Puma. Walmart has fallen nearly 20% from its June highs as channel checks point to softer quarter-to-date trends, in contrast to General Mills, which is rallying after beating earnings expectations on the back of price increases and a $3 billion cost-cutting plan through 2030. In industrials, Caterpillar shares dropped about 7% after Michael Burry disclosed new short positions, citing overvaluation concerns across major industrial and tech leaders including Nvidia and Tesla, a reminder that skepticism toward crowded winners is rising. Elsewhere, Bloom Energy has climbed after expanding its AI-focused partnership with Brookfield from $5 to $25 billion, underscoring how the energy transition and AI infrastructure are intersecting. Starwood Capital's new real estate vehicle targeting data centers, rental housing and logistics, and Abu Dhabi's $49 billion AI fund add to the picture of deep global capital pools chasing these themes. In autos, Nissan is compressing vehicle development times by about 40% and plans to roll out advanced autonomous driving to most of its lineup by fiscal 2027, while restructuring its manufacturing footprint between the United States and Mexico to manage tariffs, currency swings, and affordability constraints. Taken together, these micro-signals show a cycle where AI, infrastructure, and supply chain rewiring remain powerful supports for equity earnings, even as consumer and valuation stresses emerge in more traditional areas. Pulling it all together, equities are caught between central banks that remain firmly focused on a 2% inflation target, an AI and infrastructure Capex boom that is lifting earnings and medium-term growth expectations, and mounting concerns over valuations, concentration, and leverage in pockets such as semiconductors and crowded growth names. Market leadership is broadening toward healthcare, financials, and small and mid-caps, while valuation gaps are opening more clearly between the United States and the rest of the world, just as debt and equity issuance and regulatory scrutiny in AI and capital markets are stepping up. The key signposts from here are central bank speeches and labor data, the durability of AI-driven earnings upgrades, how far the semiconductor correction runs, and whether the current low volatility regime can withstand heavier issuance and higher for longer rates. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to @vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.